I want to talk about India now, Kevin. From a global investment opportunity, what do you find compelling?
There are so many things about India right now that look incredibly compelling. You have the largest population in the world now. You have a very young population. China has an older demographic. India has 800 million young people. South Asia as well is involved. You've got the fastest growing economy. You've got a swelling middle class, the fastest growing e-commerce market. And importantly, you have a government that's all in on digitization and has introduced things like UPI to really accelerate this. So the India story is incredibly compelling, and I am incredibly confident there will be a lot of growth in the next decade in the internet and e-commerce company.
Kevin, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Thank you so much for having me.
Yeah, if you ever wondered what Paisa Vaisa means, it's a Hindi version of, just for kicks money. It's named after a very obscure 90s song in Hindi, if you ever wondered. The title of this podcast is in Hindi. Okay, tell us about EMQQ Global and, of course, about the very famous Burton Malkiel, who I believe is on your board, author of, folks, if you don't know, Burton is the author of A Random Walk Down Wall Street. Very famous book. If you've not read it, please do. He's on your board. So tell us about your firm and everything.
Sure. So EMQQ Global is a San Francisco-based investment management firm. We're focused on the emerging markets internet space. So all emerging markets, all frontier markets. There's 46 countries in that universe, China being the biggest of those. And we invest only in the internet and e-commerce companies. And the reason we do that is because, when I first got involved with emerging markets and China in particular 17 years ago, you realize pretty quick that the thing that's emerging are the people. And there's billions of people in emerging markets, and their economies are growing faster, their incomes are rising, and they want stuff. They want more and better food, more and better clothing, they want appliances, they want to take a vacation, go to a movie, buy a vehicle, and they want their kids to go to college. And that's been a very well-documented story. I didn't have to figure that out myself. When I got pulled into China 17 years ago, it was already well-documented. And so that's what I've been focused on as an investor for 17 years. But about 8.5 years ago, halfway through my emerging market life, I realized that the way people consume was changing, and that basically the smartphone was bringing the computer to the world for the first time, and the internet for the first time, and that while in the United States and other developed markets, we have a very robust consumption infrastructure. Everybody has a bank account and a credit card. Everybody has a cable television. There's plenty of big box retail stores. But those things really don't exist in the developing world by definition. So emerging markets don't have that consumption infrastructure, and they're leapfrogging what we think of as traditional consumption, and they're doing everything on their smartphone, even more than we are in the developed world.
Yeah. Tell us about your firm, about Burton. I mean, how's your board constituted? How old is your firm, and the background on that?
Sure. Well, our firm is about 8.5 years old. But to back up, let me tell you how I started in the investment business and how I ended up working with Burton. So, when I graduated from college at the end of 1991, I showed up in San Francisco, where I grew up, and I had one interview with a firm that was called Robertson Stephens and Company, which was the leading technology investment bank. And I had a short interview. We talked about college sports, and then the person that was interviewing me said, "You can start Monday." And I said, "Well, that's great, but how can I start Monday? I don't know anything about investing." And the person said, "Well, go buy this book." And he wrote down A Random Walk Down Wall Street. So I started by reading that book. As you know, it's all about indexing. It was written before there were index funds originally in 1972. It just had its 50th anniversary edition published last year.
Wow.
And so I read about indexing, but very quickly I realized that when it comes to investing, I'm an Omaha person. I'm a Berkshire Hathaway, Warren Buffett person first and foremost. But in 1999, I was a very idealistic young investment professional, and I decided to start a company that I thought would solve problems for most investors, which was to allow people to buy stocks in dollar amounts instead of share amounts. So you could buy $5 worth of Coca-Cola as opposed to 100 shares, which might cost $3,000. And so I filed a patent on a process to trade stocks in dollar amounts, and I was trying to raise money for the business, and I had met Burt Malkiel the year before, and so I called him and asked him if he might be on my advisory board, and he said it sounded like a great idea, but he wanted to meet me first, so I flew out to Princeton, and we had a 3-hour lunch, and we've been business partners ever since, so for about 25 years now. And we sold that company to E-Trade in the year 2000, and then after that, we had another idea, which we called active index advisors. The idea was that rather than buy a mutual fund that tracks an index, we would let you buy the individual stocks to track the S&P 500 or any index, but the S&P 500 is the main index in the United States. And by doing that in a separate account, we actually own the stocks. First of all, there were a lot of tax benefits, but secondly, you could customize. So you could leave out tobacco stocks if you wanted or whatever it was. And we sold that company to a large French firm called Natixis at the very end of 2004. But just before we sold the company, Google went public. And they asked my partner, Burton, to give a talk to their employees about investing. They were about to have a lot of money, and they thought, well, we should invite Burton Malkiel in to talk to the employees because we know he's the champion of the investor. And I wasn't invited to that talk, but a few months later, my phone rang, and it was a guy from Google, and he said, hey, I heard about this active indexing. How do I invest with you? And I said, well, we don't work with individuals. We work through advisors at Credit Suisse, at Deutsche Bank, at Morgan Stanley. And he said, well, I don't want to invest with those people. I want to just invest directly with you. And he talked me into basically becoming his financial advisor. So all of a sudden, in 2005, I start going to Mountain View from San Francisco once a week to meet some new Google person. But while I'm doing that, Burton starts going to China. So he's a Princeton economist, as you know, and a couple of his Princeton colleagues were Chinese, and they had gone back to teach economics in Beijing around the year 2000. And they said, Burt, you have to come see this. Our economy's booming. And so he started going to China. They ended up writing a white paper. The Google people heard about it and called me and said, hey, can Burton come talk about China? And I said, sure. And 17 years ago, we drove from San Francisco to Mountain View. Burton talked about China, and then all these people looked at me and said, we want to invest in China.
Okay.
And I said, well, I don't even know what that means. And so from that moment until today, my whole life has been trying to figure out what does that mean and how should you invest in China and all emerging markets. And so that's how we got started on emerging markets. And as mentioned, it's all about the consumer. I mean, the people are emerging and they want stuff. They want to consume. And so that's what I told people to do for a long time, was just buy the consumer stocks, because the problem in emerging markets, the biggest problem is the index is terrible. There's a lot of growth in emerging markets, as you know, but the index, the traditional indexes, they don't really capture that. They give you exposure to the government-owned banks, the government oil companies, the legacy economy. And so people have been disappointed with emerging markets for 15 years because the return's been basically zero. And so what I realized was you have to get more targeted if you want to capture the growth. The consumer was the story, but now the consumer is getting a computer for the first time in form of a smartphone and the internet, and they're leapfrogging what we think of as traditional consumption.
Yeah, you've answered my question about emerging markets, because emerging markets have been there for the longest time, right? I mean, you had the entire crisis in 98, which was more of LATAM, and they were also emerging at that point of time. Then, of course, you had, the 2000 meltdown in tech stocks. So I want to talk about India now, Kevin. From a global investment opportunity, what do you find compelling? And you're in Bombay, you're going to be going to Bangalore, and then you'll be going to Delhi. And it's the first time that you're here. When you're here on the ground, what can you see that, I don't know if that confirms your theory. And if it doesn't, what do you find compelling?
Well, it confirms my theory a lot, I would say, for what I've seen so far. In fact, just out in front of the building here, you can see the infrastructure going in. So when I first started going to China 17 years ago, that's the one thing that was very impressive was the building, the construction, the highways, the railroads, and that type of infrastructure that really helps accelerate an economy. So that's clearly happening here. The growth rates of the GDP here show that. And really what's happening, with the emerging markets and the internet and the computer, this has already happened in China. So if you think about the way humans on the planet, first got computers, first got the internet, and were able to go onto the internet and do some sort of commerce, buy a book, sell it on eBay after you read it. That basically started in the year 2000 in the United States and developed markets. The China wave, the second wave, if you will, started around the year 2005 with Alibaba and Tencent leading that. And that S-curve was steepest in that 2005 to 2020 period. And now you have a third wave coming. And China had 1.3 billion people. The third wave, the rest of emerging markets, including India as the biggest part, they have about 5.5 billion people. And so this third wave is coming, and it's going to happen. There's going to be a huge amount of growth in the next decade and 2 decades, and India is the biggest part of that. And there are so many things about India right now that look incredibly compelling. You have the largest population in the world now. You have a very young population. China has an older demographic. India has 800 million young people. South Asia as well is involved. You've got the fastest growing economy. You've got a swelling middle class, the fastest growing e-commerce market. And importantly, you have a government that's all in on digitization and has introduced things like UPI to really accelerate this. So the India story is incredibly compelling, and I am incredibly confident there will be a lot of growth in the next decade in the internet and e-commerce companies.
Sure. So, you're going to be spending some time out here. You've been here for a while. What's the mood that you're sensing from people that you meet? Because out here on our podcast, for example, we've had a lot of guests who come in, and there seems to be a bit of a dichotomy that the mood on the economy, like you said, fastest growing, is quite good. Stock markets is a different thing, which is where the dichotomy is there. It's a little bit, there are other issues out there. But, from the people that you meet, is there any sentiment that you can get, that you can see, you can sense on the ground?
You can't help but feel it. There's energy, there's optimism, there's excitement. Everybody has a smartphone, seemingly. Not everyone yet. We know that statistically, but it has an incredible buzz, and you just walk out of the street and you can feel it. And again, it reminds me of China, when I started going there 17 years ago. And I'm very excited for India and the growth that's going to come here.
And a hoarding for index funds. How about that, huh? You saw that for the first time?
Well, and that's right. And as you drive around Bombay, I've seen probably 100 different billboards advertising index funds, which is very exciting for me because I've worked in and around index funds for 20-something years. And as you know, Burton was one of the sort of inventors of the index fund. And I've never seen a billboard in my whole life for an index fund until I got to Bombay. And so yesterday on the way to our CFA dinner, I sent Burton a picture. I said, Burton, you'd be happy to know that index funds have reached India in a big way, and you'll see them on billboards everywhere you go.
Yeah, so DSP Mutual Fund. Kalpe and Arun, if you guys are listening into this episode, he's talking about your ads. They've been on a podcast before.
Okay, sure.
Okay, Kevin, let's talk about all your products, right? I mean, you've got indices, and how do you construct these indices? We were talking about how emerging markets indices don't represent the underlying companies really well. So let's talk about your indices, the ETFs. And folks, if you really want some really good research, EMQQ's got a whole lot of stuff on their website. I think most of it is free to download for users.
Sure.
Please do check that out. So let's talk about that. In indices and the ETFs.
Sure. So our flagship product is EMQQ, and it tracks all emerging and frontier markets internet companies. There's 125 companies in that index and the funds that track it today. We launched it on the New York Stock Exchange in 2014. China's the biggest part of that fund. It's about 60%. We have a second fund, which we launched about a year and a half ago, which is called FMQQ, for Frontier Market, if you will, which is what we consider, when it comes to the internet, everything other than China in emerging markets. India is the biggest part of that. And then finally, earlier this year, or rather early last year, we launched INQQ, which is the India Internet and E-commerce Index and ETF that tracks it. So the way we do it is pretty simple. We buy and hold every publicly traded internet company that's part of whatever country grouping that is. So again, EMQQ, China and all emerging and frontier markets. FMQQ is the same without China, and INQQ is just India. And it's a buy and hold approach. We rebalance it twice a year in June and December. And it's the INQQ product. We couldn't have made it 2 years ago. I mean, 2.5, 3 years ago, there were only 2 publicly traded Indian internet companies, but there was a huge amount of IPO activity, and now there's 22 publicly traded Indian internet companies. So we were waiting to launch INQQ until there was enough companies, and we achieved that in the first quarter last year.
Okay. I want to understand how the indices are constructed in terms of, is it free float, or how representative is it of the companies that you want to be tracking for all three? I mean, China, I've always heard that there's, I guess they're liquid enough, but if you can just help us through how the indices are constructed.
Well, it's pretty straightforward. We use a rules-based methodology, and so the first thing is you need to be an emerging markets internet company. And one of the things that I realized about emerging markets is the database is a real challenge, because every country gets put into every company gets put into several boxes. The first box is, what country are you? And a lot of these companies, they may be domiciled in Singapore, for example, even though they serve Southeast Asia. They might be, in the case of the Latin American leader, Mercado Libre, operates in Brazil, in Mexico. Its headquarters are in Uruguay.
Whoa,
so if you look on a fact sheet or the database, you'll say, well, this is a company in Uruguay. Well, that's not actually reflecting the economic reality of the company. So the first thing is to make sure that we find all of the companies that really are internet companies in these different geographies. And then once we've found them all and made sure that we've got a very pure basket of companies, we use a very straightforward approach. It's market cap weighted with an 8% limit on the largest holdings, so that helps us maintain diversification. We have a market cap and a liquidity screen. And as long as the companies are emerging market internet companies, as long as they meet our minimums, we'll own them. It's, again, market cap weighted with an 8% cap on the largest. And then we rebalance the index and the funds that track it twice a year in June and December.
Yeah, could you give us a rough idea of which are the largest companies in all three indices? For the EMQQ, you said China has 60% weightage in that. So what are we talking about? Frontier and, of course, India.
Sure. So in the EMQQ, the broad emerging market offering, Alibaba and Tencent have historically been the largest parts of that. So most people know these two Chinese super apps, but there's a lot of other very large Chinese internet companies: Meituan, Baidu, Pinduoduo, JD.com. So those are some of the biggest in that fund. But there's also in that fund and in the FMQQ fund, you have Mercado Libre, which I mentioned earlier, that was the first non-China internet company that I discovered. So about 15 years ago, when they went public, somebody forwarded me the prospectus. And I was already very deep in the Chinese internet companies, but I saw the prospectus for Mercado Libre, and I flipped through to see the income statement, which is where I always start. And I said, oh, my goodness, it looks like a Chinese internet company. It was growing at 100% and had fabulous margins. So Mercado Libre, a notable company in FMQQ. Other companies in FMQQ, C Limited, which operates all over Southeast Asia. go to and grab other Southeast Asian super apps, if you will. Sure. But there's even holdings in Kazakhstan. We have a publicly traded super app called Kaspi, which trades in London, which is actually one of our most profitable companies. And then, of course, in India, we own Reliance to get exposure to the Geo platforms, which we're very excited about, especially after spending some time with them this week. We own Paytm, and we own, again, about 22 total Indian internet companies so far, and we're excited that there will probably be dozens of more IPOs in the coming years once the IPO markets start back up.
Nice. And what market cap am I talking about for the entire index for all the three of them?
I would say right now it's probably over $1 trillion, maybe $1.5 trillion.
All three of them
total. I mean, not in terms of assets for us, but in terms of the market cap.
Market cap of all
the market cap of all the companies. Yes.
Nice. And these are obviously only listed companies.
Only publicly traded companies.
And you'll get exposure once the unlisted ones make it through.
That's right. That's right. We follow the private ones a lot, and we like to know who the biggest unicorns are, which companies are coming. Obviously, Geo and its platforms aren't publicly traded yet, but Reliance is. Before we came here, we were in Bangladesh and visited one of their largest e-commerce companies. It's not public yet. It's called ShopUp, and it's fun to see what's happening in the ecosystems, and that's one thing that part of our trip here and what we've done elsewhere in Latin America last year is to go see the ecosystem, see the entrepreneurs, meet the venture capitalists. And we started in Latin America last year. And even though I've been, doing this and focused on this for 8.5 years, I was I was a lot surprised at how robust the ecosystems are. And there's a Silicon Valley everywhere. And the story is the same. The smartest kid from every country, and I'm making this black and white. I mean, you have great schools here, and the technology institutes are obviously world-class. But the smartest kid from every country goes to Harvard or Stanford or IIT. They go to work for Google or Microsoft or Apple. They go back and get their MBAs at IIT or Harvard or Stanford. And then they decide they want to be an entrepreneur. They're getting funded historically by international venture investors. Berkshire Hathaway, my heroes, have invested in several of these companies, including Paytm. And they're finding great success. And not every one of them works, but what's happening is this virtuous cycle. Every time one of those companies works and you have the growth, you have the value creation, you have an IPO or an acquisition, every time that happens, it's creating 10, 20, or 100 new startups. And there's a multiplier effect that's happening. And there's a lot of headwinds in the world today, but that can't be stopped. The genie is out of the bottle. And from Bangladesh to Bogota, Colombia, there are entrepreneurs, and many of them are building very big businesses, and that's going to go on for a long time.
Yeah. What about the downside? We're talking at a time when you've got a blow up out there in the US, the Silicon Valley Bank. You see any dangers out here with excesses or anything else?
Well, I think one thing that we can see right now is over the last 2 years, we've had a horrible performance. I mean, we were down from our top to our bottom, about 80%. And we've had lots, investing's volatile, especially in these places. And, I always stress to people, you have to be long-term. Nobody can time the stock market. I've never met anybody that can time the stock market. I don't know anybody that's met anybody. And so what you really have to do is buy and hold and take advantage of that miracle of compounding, because that's so important in investing. The miracle of compounding is so important. And so in terms of risk, we've just gone through a pretty big contraction, and then you had multiple compression. Yep. All the valuations have gone down. Part of that was because the risk-free rate, interest rates went up, inflation went up. We have a war. But long-term investors will, I think, do very well if they buy and hold these companies. And if you're a long-term investor, as you should be, you want prices to go down. If anything else you're buying, you would be happy. If your restaurant said, hey, our prices are lower, you'd be like, great. And young people are consumers of stocks, and they should be saving and investing and saving and investing. And so there are a lot of risks in the world: war, governments, inflation, currencies. But we've had a pretty good helping of the downside of risk, and I think that certainly, the Indian internet companies are no different. There's been a very big contraction in the valuations, but I think it's healthy long term, and I'm sure the growth will continue, and I think valuations seem quite reasonable right now.
Okay, Kevin, for our listeners out there who are listening in to this, can they buy your ETFs? I mean,
sure, they
they're
trade
accessible.
on the New York Stock Exchange, and I know that investors here do have access to foreign listings, so they trade on the New York Stock Exchange, and you can buy them any day.
So just head over to whichever app that we're using, because we've had a few apps out here of companies that are, that offer international investing, which at one point of time was not possible, but now they do. So is there a ticker?
We have 3 tickers: EMQQ, which is Emerging Markets QQ. There you go, EMQQ. That's as you likely know, the NASDAQ index, the QQQs are very popular in the United States, and so our idea was to, include that as part of our ticker symbol, Emerging Markets Internet and Technology. So EMQQ is the flagship. FMQQ is the ex-China version of EMQQ. And then INQQ, the India Internet and E-commerce ETF, is the third offering.
Okay. Any expenses that our listeners should be, mindful of? Because obviously when you're trading on the platform, there'll be the brokerage which the app charges or the broker charges. But is there anything also on the expense side that you can help us with out here, the ETFs?
The funds have an 86 basis points expense ratio, which is higher than the broad-based emerging markets ETFs.